Let's dive right in. The global economy for 2026 is, well, it's a huge paradox. On the surface, everything looks kind of calm, but just underneath, you've got these massive, powerful forces pulling the world in completely different directions. So let's unpack this strange story of steady instability. So you look at the headline number, and it seems surprisingly stable. The International Monetary Fund, the IMF, is projecting 3.3% global growth. I mean, that's a figure that suggests it's just business as usual, right? A steady hand on the tiller. But wait a second, that calm number just doesn't feel right, does it? It doesn't seem to match the chaotic reality we're all seeing. It really creates a puzzle. You've got this illusion of stability on one hand, and these massive conflicting forces churning away on the other. So how can both of those things be true at the same time? Okay, so the first piece of this puzzle is a huge tailwind pushing the economy forward, and that is the unprecedented, multi-trillion-dollar boom in artificial intelligence. And look, this isn't just about a few tech companies making cool new apps. We're talking about governments, massive corporations, all pouring trillions into AI. They see it as a fundamental economic shift, something on the scale of the Industrial Revolution itself. It is a full-blown technological gold rush. And the scale of this, I mean, it's absolutely staggering. Just look at this. The global race to build data centers, to build the infrastructure for AI, it fueled a nearly 40% growth in AI-related trade. Now, compare that to the global average of 6.5%. That one sector, just that one, accounted for a full third of all global trade growth. That is incredible. You know, understanding these massive shifts is absolutely crucial. If you want to stay ahead of the forces that are shaping our world, just take a quick second to subscribe so you don't miss our next breakdown. But, and this is a big but, pushing directly against that powerful AI engine is an equally strong headwind, the fracturing of the global order. The world is, quite literally, breaking apart, both economically and politically. The old model was pretty simple, right? Find the cheapest place on Earth to make something and then build this giant global supply chain all around it. But that world, it's gone. The new model is all about security, resilience, and trading within your own competing geopolitical bloc. And you can see this shift happening in real time, right in the numbers with these new U.S. tariffs. Just look at the difference here. The rates for China and the rest of the world are dramatically higher than they are for North American partners like Canada and Mexico. This isn't just some minor policy tweak. This is the construction of a regional economic fortress. So here's the paradox, and this is the crucial point. While supply chains are physically getting longer, goods are actually traveling farther around the world. They are politically getting shorter. Trade is flowing between countries that are friends, countries that are closely aligned, even if they're on opposite sides of the globe. And finally, caught right in the middle of this tug-of-war between the AI boom and the great fragmentation, you've got the wildcard, the thing that threatens to tip the balance at any moment. Persistence inflation, and the constant threat of energy shocks. Now, this brings us to what all of this could mean for the markets. And of course, it's super important to remember that this is for informational purposes only. All these forecasts are uncertain, past performance doesn't predict the future, and none of this is investment advice. Okay, with that said, let's look at the possible scenarios. You know, geopolitical tensions, especially in the Middle East, create this huge cloud of uncertainty around energy. In one scenario, oil prices peak at a level that's high but manageable. In another, though, a major disruption sends them spiking to over $140 a barrel, and that would have massive consequences for the entire global economy. So what happens when you throw all this turbulence into a blender? What's the most likely outcome? Well, while a lot of people in the markets might still be hoping for that perfect Goldilocks scenario, strong growth, low inflation, many analysts believe the most probable outcome is actually an inflationary boom. That's where you get strong growth, fueled by AI, that collides head-on with high inflation, driven by all this fragmentation and those energy shocks. So with these powerful forces all colliding, it's pretty clear the old rules for investing and for business strategy are, well, they're obsolete. You can't just set it and forget it anymore. You need a completely new playbook for this new world. This new playbook is really all about adapting to a world of permanent volatility. So what does that mean? It means being vigilant, always looking for those early signs of economic shifts. It means actively managing your strategies instead of just setting and forgetting. And maybe most importantly, it means building resilience into everything. Resilient supply chains, resilient portfolios that can actually withstand the inevitable shocks. Ultimately, understanding these three dueling forces, that powerful AI engine, the fracturing Great Fragmentation, and that inflation wildcard, that's the key. That's the map you need to navigate this new economic frontier of 2026 and to see the real big picture hiding behind the headlines. And hey, if you want to see exactly how that powerful AI engine is about to completely transform jobs and the workforce, you're going to want to click right here and watch our next explainer on AI's impact on the 2026 labor market.